Good afternoon, ladies and gentlemen. Thank you for taking the time out of your busy schedules to join our third installment of the quarterly update for 2022. I know there's a lot going on in the markets and a lot of things to unpack today. We've got a nice jam-packed agenda to be going through. Before we get started, just want to give everyone a bit of housekeeping, go through some housekeeping rules, everyone should be on mute before the webinar actually begins its full course. But before we do that, just a bit of compliance disclaimers to go through. Otherwise, they'll have my head for it if we don't go through it. So Dunhill Financial is a registered investment advisor. Anything presented in this webinar is for educational purposes only. It's not intended in any way, shape, or form to be any offer or solicitation for any strategies. Please be sure to first consult with a qualified tax professional or an advisor before implementing any strategies discussed herein. And with that being said, I guess we can sort of, dive right into the agenda. There's a lot to unpack, as I mentioned here, and we'll be going through, what's going on in the markets and the overall economy, as well as, why should I care and how does this actually affect us at the end of the day? So with that, actually, Brian, why don't I throw it off to you, and why don't we tackle our first topic, which is what's actually going on here?
Well, the most active part of the market is by far the currency market. We've seen huge moves in the three major currencies, the pound, the dollar, and the euro. It's starting to look very remnant of the late 1970s. We've seen the dollar shooting straight up, and we've seen both the euro and the pound dropping like nothing else. Now, essentially, this feels very remnant of the late 70s and early 80s, in which interest rates went shooting up because inflation went shooting up. The US, being the biggest GDP around the world, went first, and as interest rates moved up, it attracted capital. Very reminiscent of what's going on right now. Essentially, the dollar is going up because we've had 3 interest rate hikes in the US, 2 here in the UK, 1 in Europe, none in Japan or China. So naturally, the dollar's gone up the most. The moves of the last week in the pound have been the most surprising in the fast speed that they're actually moving forward. The trajectory is towards parity, it looks like.
Right.
The Bank of England is reacting today, just a couple hours ago, by having to go on some bond buying. And we'd expect more drastic measures like we're seeing, where the banks are freezing up new loans and the sorts. None of this should be shocking after the last 4 years of having to go through Brexit and the pandemic, and then now having to deal with a potential energy crisis. So we're not calling a bottom to either the pound or the euro. What we're saying is that we should be recognizing what happened in history that ended it back in the 80s. Mm-hmm. And so I'll give you a little bit of a reminder of what the Plaza Accords were and why it was so significant back in 1985. So again, we had a lot of inflation that led to interest rates moving up in the US faster than the rest of the world, and that ended up giving the dollar more strength, which slowed down their economy. Now, at the time, they called a meeting of the G5. Basically, it was the United States, Western Germany, UK, France, and Japan. Those 5 met up at the Plaza Hotel in New York, hence why it's called the Plaza Accords. And essentially, the US said, the rest of you need to sell off all of your dollar reserves so that the dollar is not so strong. In public, the other 4 said, well, something in French. In the end of the day, what ended up happening was that they did sell off all their reserves, and the dollar came down significantly. The importance of this is that something will have to happen to bring the dollar down, because it can't just have all this strength. Otherwise, the global economy will continue to shrink. Mm-hmm. A strong dollar is not positive for the world economy to certain extents, because most US companies, especially the major ones, get a big share of their revenue from abroad. So if you're Apple or if you're Google and you're doing a ton of business outside of the United States, but you're recapturing it back into dollars on a strong dollar, it makes your earnings look weaker. So essentially, we want an appropriately priced dollar in those types of ways. Mm-hmm. And that's to where essentially we're not calling a topping out of the dollar. We're saying be careful because we could have a big moment like the Plaza Accords. We still have the remnants of what happened from the Plaza Accords every single year in the G7 or G8 of the past. So you guys have all heard of this, and that's where it really originated. Mm-hmm. So,
and just to provide some color there, Brian, as you were saying, some of the sheer pace of some of these moves have been, quite dramatic. I mean, just this chart alone, this was from the 14th of September when we were putting it together, and it shows the pound at 116. And I'm pretty sure we've absolutely gone through those levels in record time, and I think we're sitting at 106 or 104 the last I checked before we came on here. So, the speed of some of these moves, both in the dollar strength as well as the euro and the pound weakness that we're seeing, has been quite unprecedented to some extent.
We hit a bottom of 103. That's where I tend to see that we're going to parity. We even got a little bit of a bounce this morning on some news that the Bank of England is going to be buying bonds to try to keep the banks. As we know, the UK is really built on an economy of housing and banking. So if we take out lending to the real estate market and the bank's ability to continue to grow their balance sheets, essentially we've got a very weak economy. We've got warnings from the IMF that the tax cuts that the new administration has put together are probably unsustainable. And essentially, sometimes the reality doesn't have to be the case. The perception is more important, and right now the perception is that this could look like an emerging market currency. Mm-hmm. in its faltering.
Interesting. I might have mentioned to mention this in the beginning, but please do continue to put your questions either in the chat or use the Q&A function. We will have a dedicated Q&A section as well towards the latter part of this session. So please do keep your questions coming in. Okay, Brian, we've touched upon the euro, the pound, the US dollar, but
let's stay on the pound just for one more second.
Okay.
Because it sounds horrendous when we're talking about the pound falling apart, especially when we're talking about on a 10-year trajectory of going from $2 to a pound to nearly $1 to the pound. In effect, for most all of us, anybody that's investing, this is a great function, because most all of you, your portfolios are going to be majority outside of the UK, and even the companies you're investing in the UK are getting the majority of their revenues outside of the UK. So essentially, for our investment portfolio, this is not problematic. Where it becomes questionable is, first of all, if you're vacationing and you're earning your money in the UK, your rainy day funds, and potentially your real estate purchase. Now, essentially, what we're looking at is a potential housing crisis or a further decline in the pound, one or the other. But when it comes to your investments, this shouldn't be affecting how you view your investments. It should be just determined inside of that.
Interesting.
Same thing goes really with the euro.
Perfect. I'm glad we touched upon that. Moving on. China's been in the headlines, sometimes for the right reasons, sometimes for the wrong reasons. But what's going on with the Chinese yuan, Brian, when it comes in context with a stronger dollar that we're seeing globally?
Well, it's a whole lot of nothing, as you can see from the chart. I mean, we're breaking new levels, which is essentially not a horrendous thing when we're talking about a debt-ridden country. But at the same time, we're not seeing the movements that we're seeing in the pound or the euro. So I'm not detracted from this so much, because still the growth rates are looking more positive for the second, or some would argue the biggest economy in the world. We're looking at what, 4.5% for the next decade, and then 3% going on thereafter. A lot less than what we've had in past decades, but still good and robust compared to what the West is achieving at this point in time. So we're still getting a good growth factor from that.
Mm-hmm. And just to expand on that a little bit, if you don't mind. Now, naturally, China's had, a number of issues over the last year. Naturally, the real estate crisis, we've just touched upon real estate here in the UK. And then, I think it was last mentioned that real estate made up to 30% of China's GDP. And, as this chart showcases, it's had quite the knock-on effect. How do you see that play into the currency and well, like you said, for GDP going forward?
Absolutely. I think we're all dealing with the debt crisis, no matter which markets we're looking at. And China is one of the bigger debt crises out there. We still have just under $1 trillion of reserves.
Yep,
the Chinese.
They were the largest. Sorry, my apologies. And now they're the second largest, just behind the Japanese when it comes to owning U.S. treasuries.
So naturally, the question becomes: is that enough to sustain them as their currency in that fixed rate, considering the debt levels? It seems stronger, and it seems to be holding better than euros and pounds. But at the same time, there's no way to really account for how much debt we're sitting on these real estate companies. So you've noticed how we've always played China when we're ready to play China. We don't play the debt side of things. We don't play the banks. We don't play real estate because we don't have the transparency there. We're going to play the technology side of things where we can at least have parallels, an Alibaba to Amazon or a Baidu to Google and such. And these remove some of those unknown variables of the debt levels and the lack of transparency to be able to navigate that rabbit hole.
Interesting. So we've touched upon most currencies, but I don't think it would be fair to finish any conversation on currencies without talking about some of the currencies that have actually managed to spare themselves from the death spiral that the euro and the pound have faced. So why have some of these currencies fared better than others, Brian?
Well, any currency that's linked to commodities is going to naturally move in a stronger fashion. We've said for years that there's been four strong currencies in the world, and it was the U.S., the U.S., Switzerland, Norway, and Sweden. And Norway and Sweden have a large commodity linkage. Switzerland is just a banking haven, and the US dollar has been on the strength. Now we're really looking at the Canadian dollar and the Australian dollar recovering in a significant way after a decade of poor commodity prices. Mm-hmm. And we're going to continue to see that as commodity prices stay high, except for most of them are actually starting to come down in certain regards.
I think that's our next slide. So we'll save that a little bit for later on there. But it has been quite shocking how some of the currencies that you would typically view in a much more pristine manner, like the euro, like the pound. Again, you can make arguments either way on where they stand now, compared to, for example, like the Brazilian real, like the the Aussie dollar and the Canadian dollar, how they fared so much better versus the latter two. Moving on then, so we've discussed, we spent the first couple of minutes primarily talking about currencies and the volatility that we've been seeing in currencies, Brian. But what does this actually mean for us? What does this mean for our clients? And what should we be keeping our eye on?
Well, we said earlier in the year that the main thing that we have to concentrate on is whatever happens in inflation is going to drive interest rates. Interest rates are going to drive the economic cycle, and the economic cycle is going to drive the stock market and the bond market. That's exactly how it's played out. And that's to where currencies have been the parts that have made or broken portfolios. So when we're, even if we're looking at, say, the S&P 500 that's down 25%, in pound terms, we're almost at break even on the S&P 500 because the pound has dropped
26%.
There
Yeah.
you go. So in our respective terms, there's actually not a negative performance from those vantage points. But obviously, the European markets, the UK markets have done just as bad as the US markets. So therefore, we're getting counter affected on there. But that beginning of the chain, the inflation mark, has really been driven by four natural elements. Three of them are transitory, we just don't know the time, and one's geopolitical. So the first one was government spending. Everybody tried to spend their way out of the pandemic. Not a bad thing. It's better than leaving people starving in the streets. So I don't think anybody's arguing that, but government spending has to be repaid. We take on the debt, we have to repay it at some point in time, whether it be by higher taxes, whether it be by cutting other expenses, or inflating our way out of the problem, which looks like it's the case right now. The second one, surplus cash savings. People saved during the pandemic. They couldn't go out to dinner, they couldn't go out traveling, et cetera, et cetera. So our savings rates ballooned up. And now all of a sudden, when everybody's going out to spend it at the same time, guess what? Drives up prices because there's only so many seats on flights. There's only so many hotel rooms or anything else. Then we had all the supply chain bottlenecks out there. We remember talking at one of these economic updates about all of the ships being stuck in Los Angeles, not being able to get into port. Now we're dealing with other supply chain bottlenecks. Here we're talking going into winter, having potential electrical grid failures because of the lack of energy. And every single bank in London is expected to come up with a contingency plan of how do they operate if the electricity goes out. How do we continue dealing if some of the manufacturing facilities don't have the energy to keep going? So we could be dealing with new supply chain bottlenecks for new reasons. But again, those are transitory effects because eventually these things will get solved. So those first three, essentially, we can say they'll be solved. We just don't know when exactly they'll be completely solved. The fourth one, Russia-Ukraine, becomes the Achilles heel that could be lasting for a long while. This is truly the Vietnam moment for Russia. This is something that they're going to be dealing with for years, and therefore we're going to be dealing with for years in the main commodities that come from these two countries. And those three commodities, Ukraine, wheat, natural gas, and oil, over in Russia.
I think our next slide actually touches upon that as well, where, naturally you've touched upon these four elements here, Brian, but maybe we could provide some answers to our clients on the third element, which is really the supply chain bottlenecks and what we're seeing in some of the commodities. When I was actually putting this slide together and putting getting the data, it was actually quite surprising that there were only, 3 or 4 commodities that were actually still in the positive year to date. And now out of the 4, I think it's only 3 now that's actually positive. But what are your thoughts here? The moves and the volatility that we've seen in commodities, both to the upside and now as they gradually come back off their highs.
Well, commodity prices are going to be a leading indicator to what we would expect inflation to do. If commodity prices are going up, naturally, we'd expect inflation to go up. So therefore, if we're getting volatility coming down on commodity prices, we would expect that to pass through to everything to do with CPI. That would be just the simple expectation there. Now, oil coming back down, that being the one that earlier this week, you had to change your slide because, it was no longer 4, it was 3. To me is the most significant because it is basically, it's not a part of CPI, but it passes through to the cost of nearly every good that we have. Something doesn't get on our shelf unless there's some sort of oil because of plastic, because of shipment, because of manufacturing, because of every single element. So as the prices of these commodities come down, that would imply that we would expect inflation to be coming down in due course.
Interesting. And just for the folks who can't see the lines all that clearly, so naturally the only commodities that are still positive year to date are gas, wheat, and corn, which Brian, maybe you could shed some light on, well, why those three in particular are still at all-time highs. And as Brian was mentioning, oil is actually negative now for the year.
So wheat, naturally being Ukraine's major commodity, it's being driven up because, well, there's the speculation that they're not going to be able to get it out. Right now, we still have a ceasefire, I believe, in the Ukraine, letting the ships out, but there's rumors that that's not going to last too long. Well, I say right now, I don't know by the time we post this video whether that will be the case. Naturally, natural gas is the same way. Corn is the anomaly there. Now, you had one theory on this, I had another theory.
We did. We had different theories, but I think, mine was more so in relation to the fact that I think both of us came to the conclusion that it was weather oriented, but my conclusion was, well, it was because we had a terrible heat wave in China as well, which affected the crops there. So naturally they have to import a lot more. But what were your thoughts on that?
Yeah, yours was a demand-driven session for China. Mine was a supply-driven session because corn and Pinot Noir have always been said to be the most susceptible commodities when it comes to hot weather, right? Now, there's no Pinot Noir futures, so we can't actually put that down on the sheet, but for all the wine drinkers amongst the group, you know that Pinot Noir is the hardest to grow in hot weather. So corn has been affected by those heat streaks that we had the last month or so. And that's where it's been supply and demand driven in those types of ways. It's probably a mix of both.
Interesting. Moving on. So Brian, I know we briefly touched on, the supply chain side of things and how, the commodity prices going way out of whack naturally fed into the inflation. It certainly didn't help. And then naturally, well, when you have commodity prices going up, a lot of the freight rates as well to ship those commodities to and from the different continents, they also saw a bit of a sharp uptick and a downwards tick to where we're actually now back down to where we were just before the year. But what are your thoughts on the shipping rates and how they interact with some of the inflation that we're seeing? And particularly if I actually go to the next slide, and we'll skip a slide, which shows the difference and the widening spread that we're seeing from Shanghai to LA, and then naturally from LA back to Shanghai.
Yeah, it's a complete reversion to the mean, which is really good news, because that would imply, again, that commodities, supply chains are going to normalize, and that portion, one of those four, is transitory in effect. Now, this can be a mix of all kinds of different functions, which are much longer term than just in the short term, because we have had this onshoring movement that we've seen for over a decade of more and more commodities or more and more manufacturing happening closer and closer to home. But the majority of this is just a reversion back to the mean, and normalization of pricing as more and more of that speculation goes by the wayside, and the supply chains normalize again.
And what are your thoughts on maybe this gap narrowing a little bit more, and potentially maybe explain to the audience why the shipping routes from Shanghai to LA are so much more elevated than the bump up that we've seen from LA to China instead?
Well, it's historically always been that we buy more from them than they buy from us. Where we get these nice, beautiful malls made out of shipping containers down in Shoreditch, and I know there's a couple over in Amsterdam and such. Do you have any thoughts on Los Angeles to Shanghai?
So I was under the assumption, at least from what I was gathering from the data, that the COVID zero policy in China certainly hasn't helped in any regard to this. Naturally, we've seen the headlines of the shipping containers being stacked up till Kingdom Come in LA and Port Beach, and the ports there struggling to really deal with the flow there, and that's operating on a somewhat semi-regular capacity, i.e. not being shut down completely at all. Whereas the ports in Shanghai, there've been certain days where they've been completely shuttered.
Absolutely.
So what are your thoughts there, and how do you think the COVID zero policy will continue to impact some of the imported inflation to the rest of the world?
Absolutely. It's one of those effects that feels quite transitory, in that it can't last forever. But at the same time, they've been feeling like they need to keep this completely under control. They can't let it run away. Now, essentially, that's slowed down their economy significantly. And if interest rates started to really spike, it would hurt them much more. Well, then you'd have complete stagflation. But we have to just hope that it's transitory in those effects, that this is a month by month instead of quarter by quarter element.
Perfect. I'm just doing a quick time check in. We're nearly to the halfway point. So, I really want to get towards the Q&A segment from the audience as well. So we'll quickly jump onto the next slide here, which shows where we could expect actually inflation to be in the coming months. And at which point maybe we can potentially, breathe a bit of a sigh of relief. And what are your thoughts on here, Brian?
Well, first let's take everybody through this slide a little bit, because you got a lot of numbers on there.
A lot of numbers, a lot of colors. So let's step back a bit and break it down.
So basically, from top to bottom, we just have a time parameter. So starting now all the way down through November of 2023. Now you'll notice that no matter which segment we're looking at red numbers down to green numbers. So we're looking at improvement over the course of time. It just is a question of how fast this is going to happen. So that's why I call 3 of them transitory, 1 of them not. I tend to think that we have to get through winter to figure out how bad things are going to be from an oil and natural gas vantage point to be able to control this inflation. Everybody's going to be speculating of how bad the winter is going to be. And until that, we're not going to be able to get ahead of these inflation numbers. But you can see post February, pretty much across the board, we're looking at decent numbers. We're looking at controllable numbers. And that to me is the important aspect, that we will get beyond this. The faster we rip off the Band-Aid and get rid of the cheap money, the more we slow things down, the more inflation will dissipate, and then we won't have to raise interest rates so much, so we can get back to business as usual.
Interesting. There's some useful insights there. So perfect. I think we've touched upon what's going on, Brian. We've touched upon how does this potentially affect clients and why they should be paying attention. And then the last point is, why should we care? What's really driving this, and why should we be looking at, what potentially some of these central bankers are doing and how that might interplay with bonds and with other parts of the market?
Absolutely. Not to get in the way of some of the future things that you have in future slides. Mm-hmm. Really, when we're looking at the interest rates, it's really driving currencies in a big way. That's first of all. Second of all, it's driving mortgage rates, which if you have a fixed rate and you have your home, you can ignore that. Doesn't matter.
Yeah, I think we've got a dedicated slide.
Exactly.
To that.
So that's why I don't want to take away that. But third of all, it's going to affect your overall portfolio. You were running the analysis of our current portfolios. And even though the bad news is pretty much across the board, doesn't matter number of stocks, bonds, pretty much everybody's accounts are down, but the yields inside of the portfolios are up. Across the board, I think you were telling me that everything's got a 4% or higher yield inside of them. So just to make the simple analogy, that is like the value of your house going down, but the rent that you're receiving from renting it out going up. In other words, as long as we're not looking to sell it tomorrow, we don't mind because the rent's gone up. So the more these interest rates move up, the more we're going to see currencies move. Mm-hmm. It's going to affect our mortgages, and it's going to help our portfolios to get those higher yields, mm-hmm. Normalization.
I think we've really touched upon those interest rates, and here of the major different countries there and some of the divergences that we've seen. Maybe if you could just provide a really quick comment here, Brian, before we move on to the next slide of, why we're seeing some of these changes, why certain countries are acting in the order that they are acting, and potentially how that interplays with the currency.
Well, I've said it before that essentially the typical order of things is that the US goes first, the UK is the US's lapdog, so they get to go second. Europe gets to go third, Japan goes fourth, and when China gets around, call them currency manipulers. And that is exactly the order that's happened. The US has raised the most 3 times, the UK twice, Europe once, Japan hasn't touched, they're still pegged at 25 bips, right? Mm-hmm. And then essentially, well, I guess when I was talking about power outages, it happened sooner than I expected. And essentially, China is essentially stuck doing nothing. So the same order is happening right now that historically happens. Now, naturally, you want to raise rates the most early on, but you can't push down the bathwater with both hands. It's just going to go right around the side. So if everybody tries to push up rates all at once, it's just not going to have the same effect and the same speed. That's why the US always gets to go first. I think they make up 19% of the world's GDP. So everybody knows if they try to get in their way, they're probably going to get railroaded anyways. So might as well take the cheaper currency to essentially get that little bit of a jolt in the meantime. But if the US gets a cold or sneezes, the rest of the world gets a cold, right? So if the dollar gets too strong, basically the US economy is going to slow down significantly because they get so much revenue from abroad. And therefore, we're going to end up seeing the whole global economy slow down more significantly. And that's where what we'd love to see is the inflation slow down in the United States. If inflation slows down in the United States, the Fed won't have to raise rates so much. Then the UK and Europe can really catch up. There's some rumors that now the UK will have to catch up.
I was just about to get to that next slide, which is, some of the comments that we've been seeing from the Bank of England, the Bank of Japan, and the ECB. It's probably, like you said, reaffirming some of the historical precedents that we've seen, that the US always goes first. But now we're seeing the other central banks really wake up to, the severe weakness in their currencies, and they're, quite frankly, they're not comfortable with where they are at this point.
They shouldn't be comfortable. To see so much wiped out essentially means that you're losing value for your citizens. Essentially, when you go out and spend, it's not worth as much if you're sitting in pounds on a 10-year basis from going from 2 to 1. The problem becomes when you start raising rates significantly here in the UK. Does it actually act in correlation with rates? Are people actually buying it up at those higher rates? And at this point in time, we have not seen that happen. That's why you hear people talking about the pound acting like an emerging market currency. When you raise interest rates, it should attract. Right now, raise interest rates, it doesn't attract any capital.
Right. I think John also put it quite spectacularly in his newsletter, which is, we're very much playing a game of chicken with many of these central banks and their currencies to figure out, where is that breaking point where something gives in, and we finally see that topping in the US dollar, as you were mentioning earlier. One final slide here, which is just showcasing interest rates across the globe for 2022 before we hand it off to my colleague Anya to discuss a little bit more on interest rates and how that affects your financial plan. But is there anything that surprises you on here, Brian, on this little chart that we're looking at, where, for the most part, most countries across the globe, even Europe, finally, getting out of the negative territory for quite some time. But what are your thoughts here on, for example, Turkey and China being one of the anomalies to being one of the few countries that did cut?
Well, Turkey has this, Erdogan has this belief that you can thwart inflation by lowering interest rates, which leaves every economist scratching their head. And I think this is a little bit skewed because Russia raised their interest rates to 20% and then decreased them back since then after the ruble actually increased. So I would still put that as raised from their 15 to 20 and then come back down just because they cut capital flows. They had 4 ways of basically increasing the ruble, which was basically cut everybody else off access to the ruble.
And then demanding payment in rubles.
Exactly. So I feel that this could be actually pretty much all red for the most part. We started breaking it down in there, but at the same time, inflation is a global issue. Oil, there's not a country that is not significantly influenced by oil prices, and oil prices went through the roof from a negative point in the pandemic, and that's where we'd expect it to mostly be right.
Perfect. Hopefully the audience found some useful insights there. And now onto our next slide, where we have Anya talk about, how some of these rates maybe affects your financial plans, particularly your mortgages. So welcome, Anya, and why don't you take the stage?
Thanks so much, Cam. So definitely with the increasing rates across the board, we're definitely seeing mortgage rates increasing as well. The 30-year mortgage in the US is approaching 7%, certainly a level we haven't seen in a long, long time. Mortgage rates are still better in the UK and Europe, but they're definitely on the rise as well. So in the light of that, refinancing your fixed rate loan is definitely a lot less attractive than it was a few months ago. But that's, of course, if you're lucky. If you have a fixed rate, then you don't really have too much to worry about, except for a lack of refinancing options. But for those of us that have variable rates that are subject to frequent adjustments, especially sometime in the next 3 years or so, it definitely might be wise to look for a fixed rate, or maybe consider paying off your mortgage depending on your financial situation. If you have a mortgage with a fixed rate for another 3 years, definitely mark your calendar to make sure to shop around when your term expires. Now, an important consideration, if you have a mortgage in a foreign currency and you have a US association, is the fact that you have an obligation to file taxes in the US. And therefore, you want to be careful when paying off or refinancing your non-dollar mortgage. This is because the IRS views such transactions as taxable events for US tax purposes, and that may result in a foreign exchange gain. So I want to give a quick example, because this is a little known tax trap that's very applicable right now as the dollar is strengthening against most other currencies. So if we look at someone maybe who purchased or took out a mortgage in the UK for £100,000 when their exchange rate was pound to $1.50, at that time, the IRS would look at that mortgage and value it at $150,000. Now, let's assume you're looking to repay your mortgage right now, and it was an interest-only loan, so your balance is still £100,000. But now the exchange rate, let's just call it 110, £1 to 110 for a dollar. So the IRS is looking at this mortgage and valuing it at $110,000. So that differential, 150 to 110, $40,000, is something that the IRS is going to look at as a currency gain, and it's going to be taxed as ordinary income. Even though in pounds, you just took out £100,000 and repaid £100,000, you just created a tax liability for yourself. So definitely take that into consideration if you're paying off or refinancing your foreign currency mortgages. We'll talk more about real estate on our real estate webinar on October 12th. So we definitely want to invite you to that. But for now, if you need help evaluating your overall financial situation and how that relates to your mortgage, definitely let us know. And if you haven't already done so, definitely go ahead and upload your mortgage statement to your Vault. We'll be happy to discuss the best ways to manage those rate risks. With that, I'll turn it over to Josh to continue the discussion about rising rates now in the bond market.
Brilliant. Yeah, thanks very much for that, Anya. So brilliant as always. By the way, Brian, I feel like you always mention the UK as being the lapdog to the US just to see Cam squirm. But anyway,
Of course.
So that's what we're here for, right? That's what this is all about at the end of the day. Okay, great. So we've talked a lot about what's going on in the market. Now, we've had a bit of the bad cop about bonds, but really I wanted to come in and be a bit of a good cop from the vantage point of, despite everything going on out there, all this market movement means that bond yields are higher. So, well, what are yields? Well, yields are the amount that are paid out, and really what you need to know is they tend to work in opposition to bond prices. So as bond prices go down, yields go up. So you can see how this has been playing out throughout the year by just looking at what most people do when it comes to analyzing the attractiveness of bonds, and that's looking at the 10-year Treasury yield, like you can see here. Compared to the S&P 500, yields have actually improved quite a bit as rising interest rates that obviously are meant to curb inflation have been pushing bond prices down, and therefore yields even higher. And so what? Well, it means if you have any cash on the sidelines that you don't need for, say, 6 months to a year, we can take advantage of that. And remember, You can get FDIC coverage in the US on these sorts of things up to $250,000. We might even be able to hedge it back to euros or another currency to manage the risk on the table and moving into those currencies at a later point if you have the sort of that international flavor to your situation. This is something that Brian hasn't really mentioned much for the past decade or so, but it just kind of goes to show how this year in particular has thrown us quite a few curveballs, and this is one such example of that. Just maybe live in interesting times, as I know Cam likes to say a lot. So shortly put, bonds have becoming more and more attractive throughout the year. If you find yourself in the situation like I'm describing, feel free to reach out. I'd love to have a conversation with you about your particular circumstances and just how we could best put that available cash to work. So that's basically the idea there. With that, I'd like to introduce us over to a message from Isa on our team. We'll have a message to talk about the ESG aspects in our portfolios and what we can do to hyper-personalize them to your circumstances.
So in the past, we've spoken about making portfolios more socially responsible and how important this is to us at Dunhill Financial. Of course, constructing these portfolios, this is one very important aspect, but ultimately, we construct the portfolios for you, and the portfolios in general should be about you, not about us. And when we're speaking about customizing portfolios, we take a couple of things into account that are important for your life, in your life. And so, for example, we take into account the risk tolerance that you have. Or we also look at what country do you currently live in, what country do you want to retire in, what other currencies to personalize the regional exposure in the portfolio. But ultimately, these things are the portfolios that we construct with you in mind, but it's our portfolios, not yours. There's an easy way, though, to personalize that and to really hyper-customize your portfolio. We have this nice little questionnaire, which takes about 5 to 10 minutes to complete. And if you take the time and complete that, you have to just respond to a couple of questions that aim at what is your risk tolerance, but also look at your financial personality. It's going to ask you a couple of questions that are more looking towards how do you perceive things in the financial markets? How do you see certain trends? What are topics that are really close to your heart? Based on those answers, it builds a little analysis that contains 4 different aspects, like, for example, how important is purpose to you, or viewpoints. What is the important on viewpoints for you? How do you see certain things? Or also, what does security mean for you? Is it really important? Is it less important? These kind of things are looked at in this questionnaire. Once you completed this questionnaire, we will be able to really build a hyper-customized portfolio for you. Based on your answers, it's going to look at those certain topics that are really important to you, or that you find really interesting, or that you see evolving in the market, or you think in the next 10 years, this is going to be the really next big thing. And based on those theme allocations, we can then include a certain amount of funds that aim at those topics or trends in your portfolio, while also managing the risk, so that including those funds that are normally not in the portfolios that we would offer for you, including those funds is not going to shift your risk tolerance to the negative. It's still going to balance it out, while you can actually build a portfolio that is important to you and that you feel you can identify with, without having to take on extra risk. So this is going to be your portfolio, not just ours. It's really going to be what you think is important, what you care about. And yeah, the portfolio is just going to reflect who you are.
All right, brilliant. So yeah, we talked a bit about knowing your particular circumstances on my side, and also with Isa regarding the portfolio that we can just sort of tweak in your favor there. So One other thing that I wanted to go over real quick. So we have a new team member. So, as you know, we're always growing the team here at Dunhill Financial. His name is Brendan Marcello. He joined our team at the beginning of the month. He's American, originally from New York, and has been living in the UK for quite a while. Most recently worked for Deloitte. We're very happy to have him on board, and you'll probably be hearing a lot from him either in the emails or from other social media or webinar aspects later on going forward. So just be on the lookout for him as well. And just he'd be happy to have a conversation with you like all of us would. So with that, I think I will turn it back over to Brian and Cam, and we're going to have a sort of a finishing thought, right?
Okay, thank you very much for that, Josh. And we just move forward to the next slide. We've got a nice quote there from the late Queen Elizabeth. But now at this point, I really just want to open up the floor for Q&A. And whilst we wait for those questions to flow through, Brian, do you have any remaining comments or remaining thoughts on what we could look to expect over the next couple of months that remain for the year?
I think we have to stay with the old adage that we need to stay calm and carry on, as you would say here in England. I think even more so, it's the element that we want to make sure that we're fearful when everybody's greedy and greedy when everybody's fearful. Right now is definitely a time where everybody is fearful, and I'm definitely seeing a lot of attractive elements in the market that I can't wait to start buying, but we're not just ready for it because we haven't necessarily hit a bottom. But once we do, there's going to be some great opportunities out there, especially amongst emerging markets, especially amongst a lot of the banks that are sitting in single-digit price to earnings multiples and the likes. And the currencies are going to be a great opportunity for us to finally make that switch after 14 and a half years of a dollar bull market to eventually coming back down, because nobody wants to stay that strong for that long.
Right, and I know you just touched on the sentiment. We'll just give the audience a few more minutes to get the questions in. But we had a little slide at the end of the appendix here on exactly that, which was the sentiment, that we haven't seen sentiment this slow in quite some time. Whether it's the COVID pandemic, etc., or whether it's the 08 crises. Again, this is a little late here on this part, so the sentiment is probably much lower than what it showcases now. But what's your viewpoint on sentiment being so low? And
we had a slide on this a couple times ago. I don't know if you remember. That was the correlation of the market in the next year compared to consumer sentiment. That time it was the Michigan Consumer Sentiment Report. And it was great because whenever sentiment was at its lowest the next year, the performance of the markets was the best. In other words, yes, we've had 5 times in the last 25 years where the markets dropped more than 30%. Right now, the NASDAQ's down more than 30%. The S&P is down, 25% on the year, 24, 25, something like that. So yeah, this is precedented. We've had it 5 times in the last 25 years, yet we've had wonderful growth over the course of the overall 25 years. So we're not worried about it from that vantage point. And what we normally find is that's when we can go cherry picking and all of a sudden find those great deals. So I think we have to just stay the course, make sure that we think for the long term, and make sure that we look for good quality across the board to make sure that we don't end up with those dogs that might disappear. We've talked about several of those companies that might not exist next year. As long as we stay away from those, we'll be golden.
Perfect. Let's just have a quick look at the Q&A function. So again, ladies and gentlemen, you can put your questions either in the chat or in the Q&A function there. One question I had for you though, Brian, was, we've had this discussion on when the dollar tops out, when the dollar and the rest of the currencies start to rebound, when that does eventually materialize. Again, we don't know how that would materialize or when that would materialize. What are some of the places that you're looking at to take advantage of the opportunities of, a reversal in the strength of the US dollar?
100% emerging markets. Emerging markets primarily post-winter, getting back into Europe. for sure. There might be one or two opportunities here in the UK, but it's not necessarily at the top of the list, being so banking heavy over here. But essentially, emerging markets. The other nice place to go is, and I know it feels repetitive, but what we've got to remind ourselves is that we finally got interest rates on bonds that are quite attractive. And once the dollar tops out, we don't have to necessarily be looking at only positions in a company in an emerging market that has currency and equity risk. We can be looking at diversified fixed income X dollar. For our European clients, we've used Michael Hasenstops several times to hedge this type of risk, where we get emerging market debt. When the dollar's going down, that is just magic, because you're getting higher interest rates, where we're talking double-digit interest rates, and a dollar going down compared to their currencies. So I would definitely say emerging markets in every kind of way.
Perfect. Well, you've hit it. You've heard it here first, folks. We've got one question from Nancy. Logistical question. Can I view a recording of this? Unfortunately, I missed quite a bit. Yes, so there will be a recording sent out within, I'd say, the next 24 hours or so. It'll be up on our YouTube channel, Nancy. So if you haven't subscribed, please do go ahead and hit the bell notification and smash that subscribe button, and you'll get automatically notified. But we'll also have a follow-up in our October newsletter, so that'll be going out shortly in the next couple of days as well. So stay tuned for that. I think we've got a bit of a shy audience here. Not a whole lot of questions flowing through.
Well, we got 7 minutes that we can play around with questions across the board. Well, Josh, are you still around?
Oh, I'm still here. You haven't got rid of me just yet.
Beautiful. Hey, I know you've been playing around on the bond desk over there. Any good CDs that you've been playing around with in the shorter term? What kind of yields have you been looking at over there?
Yeah, it's a good question. So we were talking about this just recently. So they have been getting more attractive, kind of like related to what I was just talking about. If I could just pull my figures up. So right now we're looking at, sorry, dramatic pause. Well, I guess generally speaking, you're going to be looking at the 6-month rate and the 12 and 18 months that we were talking about. Generally, these are somewhere between, see, the best rates for September, we're looking at somewhere between, say 3.55 is probably the best one we've got right now. And generally, you're looking at the higher end of 2, or yeah, so 2.5 to 3.55. Now that's just the 6-month rate. It does sort of go up from there when you get to 12 and 18 months, but just kind of reflects how, just basically with bond markets being what they are, these are just going to naturally be more attractive. So like we were talking about, it doesn't mean that we don't always have to be thinking in terms of equity, especially in times like right now. We do have those other components because, I mean, these are more in the fixed income side. So, I mean, strictly speaking, that's just something where you know what you're getting. Just we have to make sure that we're putting those in with companies that we know, or at least can be reasonably sure will still be here. And like you said, aren't just going to disappear next week or next month or next year.
Absolutely. So in other words, for that 1 or 2 year money that might be going towards a house purchase or something near term than the long-term retirement, when you're building that out with Anya, all of a sudden, you might want to give Josh a call and put that into a better yielding instrument.
Yeah, absolutely. Why not make a little bit more from the interest on that instead of having it just sit in the bank and have inflation be your main worry? This is just one of those sort of other tools we can have in the toolbox, and we're just fleshing out the financial picture and just sort of the best things to do when, like Brian said, when everybody's fearful. Well, there are these opportunities out there. So we just want to make sure that we stay on top of that, and we just can find the best ways to put the money to work. That's kind of the name of the game here.
Absolutely.
So I guess maybe one of the, just to throw another metaphor at you, is that something falling knife is kind of what I'm getting from a lot of this.
Well, definitely the currency markets are a falling knife. The the equity markets have a feeling of it depending on which side. The growth side of the market, i.e. the tech side, more so than the value side. But essentially, those can continue to fall much further because of the higher valuations. The value side of the market seems to be stabilizing some in those types of regards, and that's what we'd expect in high inflation time periods. But if Cam's slide comes about where March, April, we're looking at inflation dissipating away, then we could be looking at the exact opposite, that a recovery could be happening faster on the growth side of the market than the value side of the market.
Mhm.
It all depends how high interest rates have to get. If we're talking about 7% mortgages across the board, like Anya was talking about, that can be actually tough for the growth side of the market to continue to rally in those types of ways. But growth to value historically used to be every 6 years that it'd switch over. And 6 years turned into a 16
Decade.
years.
Yeah.
No, it was more than a decade. It was
Decade.
definitely more than a decade.
Yeah.
So it might be healthy to have a time period that value outperforms growth, or that we have these true conversations again of, is Apple really a value company, or is it really a growth company just because it happens to do tech?
Right.
Yeah, you guys had put out some interesting analytics about that recently, right? So I guess it was fair to say that the last decade has been really great for growth. Does that mean that we're going to be seeing a shift, you think, back towards the value aspect of it?
I think one of the interesting parts of research that we did was, since the inception of the markets, value has naturally trended. The markets have spent more time in a value-driven market than they have in a growth-driven market. Now, naturally, you could make the argument, well, you didn't have the Amazons and the Googles that you do today in the 21st century that you did in the 19th and the 20th century. And actually, even during the dot-com era, a lot of these companies were still very, very nascent and still developing. So the question then becomes, well, does technology continue to grow and continue to disrupt and improve, the efficiencies, or is this time different? Which is always a famous last word of any economist or trader.
You're going to have different sides of the tech mill.
Right.
You look at the acquisitions that, say, an Amazon's been making in the last couple of years. They're very much value plays as they try to use their higher valuations to beef up everything going on and increase their analytics inside of it. Therefore, what are they trading at? 105 multiple right now? Can't stay strong too long term when they become more of a grocery store than they do an online delivery portal. Nor would you want them to stay at 105 value. We want those earnings to finally start to show up in due course. Like I said, an Apple at a 25 PE ratio starts to look more like a value stock than anything else. But the forward-looking aspects of the marketplace, whether it be the metaverse or EV or any of these types of functions that haven't shown those types of earnings, should still be looking at like growth engines. So we'll probably be looking at just dividing up the sphere into two groupings.
Perfect. Well, I think we're nearly there for time now. So before we sort of conclude, I want to thank everyone for joining this session here, third installment. Again, we'll be sending out a recording very shortly on our YouTube channel, as well as the follow-up with the slides if you haven't already had a copy. But again, feel free to post any questions either afterwards, offline, and if you'd like to have a discussion separately, again, always more than happy to field those questions as and when they come along. But other than that, I'd say, stay safe, stay well, and we'll be in touch over the course of the rest of the year.